Okay, we'll go ahead and get started. Welcome everyone to Copperwynd Financial's Q3 economic and market update. I'm your moderator slash host, Javier Jimenez. On this call, we also have David Daughtry and Eric Newton. A few housekeeping items like our past webinars is this webinar is being recorded. So if you have to hop off early for any reason or you want to copy the deck, we can always send that to you after. It'll be on our website probably later this week as well. And so really what we've done here is over the last few weeks and months is really kind of listen to see what were the top questions in our client meetings and what we've been hearing a lot of in the news. And we put together a little presentation here. Let me go ahead and share my screen where we can go over the top pressing questions. Feel free also to use that question and answer button at the bottom of your screen. We'll try our best to answer all the questions during the presentation. We also have about 15 minutes at the end of the presentation to go over more questions and answers. For whatever reason, if we can't get to it during the presentation, we'll follow back up with you to go over that. We have about 30 to 45 minutes of prepared remarks. And the first thing that we wanted to go over that we've been hearing a lot of is really the recent volatility in the market. I'll go ahead and let David take this over to speak in more detail.
Great, thanks, Javi. And we have had some pretty amazing volatility, and this is just the volatility of the VIX index, over the last year. And what you see is most of the time it's been between 10 and 20. I mean, it's bounced along 10, 12, 13, 15, occasionally hits 20. And then on the basically a little over a week ago, jumped up on that Monday to over 65. And when you see a spike in volatility like that, it's usually is the occasion when something bad is happening, something uncertain. But it usually is like if we were be fortunate enough to be sitting on a beach in San Diego and we were making a sandcastle, you'd make it higher and higher and higher and higher and higher. And at some point you would put a little more sand on and it would all collapse. And that's sort of the way you see in the volatility occurring, except it's the opposite of collapsing. It goes through the roof. And it's usually not exactly what happened that day or the day before. It's a buildup of tension in the market, a lot of times preceded by a lot of uncertainty or the market going up a lot. And what we've seen is the tech side, especially like the Magnificent Seven, going up dramatically, and then some uncertainty. And we'll talk about some of that uncertainty. One of the things that caused that immediate jump was Sunday, which was Monday in Japan, is the Japanese market selling off dramatically. Now, this is one of the ETFs for Japan, and over the last 6 days before, I mean, it dropped 11%. But the Nikkei 225, which is sort of the equivalent of the triple Qs, they dropped 12% in one day, and that Sunday evening session, which was Monday for them. And everybody said, oh my goodness, is the market here going to open up down 10? Well, it didn't. It opened up down 3 to 5, and it stayed that way the entire day. But if you look at the triple Qs, which had gone up the most this year, the Magnificent Sevens in there, for the previous month, it was down about 12%. From its peak intraday, it was down 16% during that month, but not 12% in a day. And sort of giving you what the equivalent of 12% drop in the market, for the Dow, that would have been a 5,000 point drop nearly. So think about if you woke up and they said, oh, the Dow's down 5,000 points. And so in Japan, there was a lot of panic, and it went over to a lot of different markets for sure. But those things are happen, but fundamentally we still are comfortable that the market is not, the economy and the market, and we'll go through all of that today, is not, it's still okay. It's still in pretty good shape. But now it's funny because we talked a little bit before we started this. We've got a good group here today, it probably would be twice this size if it were a week ago and the market had dropped as much as it had. Uh, so now it's, what are we looking at? And, I think now we focus more, and I'll have Eric talk about, what's the Fed's next move? That's where we've gone from, not, what's happening in Japan.
Yeah, we've talked about the Fed and the FOMC lowering interest rates for a while now, not only in our webinars, but in our one-on-one meetings with clients. The chart that you're looking at right now goes back to the early 90s. You see the gray bar, the history of the Fed funds rate, really the 5.38% that we're at right now. And the blue dotted lines and the diamonds are what the Fed is projecting, the conversation they're having, that over time, they are going to cut rates from the 5.38 down to the purple diamond, which is the terminal rate, long run projections of 2.8%. They have held interest rates high to combat two things. One, inflation, which is most of what we've been talking about. And now that inflation seems to be getting under control, it's not is the Fed going to cut? It's when. And for everything that they've talked about, they are ready to cut 25 basis points at their next meeting in September. The green dotted line is really the market expectation, or what the market would like the Fed to do, which is not only cut, but cut faster. We actually had a meeting yesterday with the wholesaler who was their base case expectations between now and the end of the year is that they expect the Fed to cut 100 basis points before January 1st. Really, I think their thought was 250 basis point cuts. Now, again, they as a firm may be hoping for that. Doesn't mean that that's actually what's going to happen. But really, the Fed has already started to signal that they are going to start to taper off their restrictive policy, having interest rates at a high level, and because they're starting to shift their focus not really from inflation now to what does the economy look like? Full employment. That's their second mandate, is to have price stability and full employment. Now that we have price stability, prices are not going up as much as they used to. Now it's focusing on the economy. The second thing they're doing in moving to a less restrictive policy is draining liquidity. This is a chart of the Fed balance sheet going back to early 2016, kind of pre-pandemic. The Fed held on their balance sheet treasuries and mortgage-backed securities around $4.5 trillion, large dollar amount, but and had done that for a while. You see the gray area, which is the recession that we went into because of the pandemic. The Fed, to help the economy, loosened and started to buy a lot of treasuries and ballooned their balance sheet up to north of 7 trillion, peaking out kind of at the end of the pandemic at $9 trillion. Since then has now started to taper off and eased its approach a little bit. You see a little bit of a blip at the beginning of 2023, which seems like 100 years ago. That was the regional banking crisis. For everyone that's already forgotten that that occurred, they ramped back up to support the economy. And then once we moved beyond that, they started to let that roll off. They're not buying as many treasuries. For everything that matures, they're not adding it back to the balance sheet. And so back down to kind of a right after the pandemic, $7 trillion, which is still a lot. We don't expect them to get back to the 4.5 trillion. Mathematically, that would probably take a very long time, as well as something will probably occur in the economy between now and them getting to 4.5 trillion. But it is a much better approach, both on the interest rate side as well as the balance sheet side. The other thing in talking about the Fed's next move is the Jackson Hole Economic Symposium, which actually is hosted by the Kansas City Fed. That's going to occur next week. So instead of an FOMC Fed meeting in August, they take a break and they really get from around the world central bankers, policymakers, economists, academia to come together and have a discussion more broadly. It does allow the Fed Chairman Powell to continue to telegraph what it is that they are going to do. We don't expect any sort of policy change at the meeting. It's a Thursday, Friday, Saturday meeting next week. It will give Powell a chance to reiterate a quarter point cut in the Fed funds rate in their September meeting. And so the next move by the Fed is kind of already predetermined, and they will continue to beat that drum. And so now it is trying to understand, okay, how does the economy affected by these interest rate changes? And so, Javi, I think you're going to talk a little bit about, is a soft landing still on the table? This is kind of the most anticipated recession that never happened. So we can go into that in a little detail on how is the Fed managing the data that we're seeing.
Yeah, thanks, Eric. And so to say if a soft landing is still on the table, there's a few things we're looking at, right? In order for that to see if that's going to happen. One is GDP. So you look here on the right-hand side, you see Q1 GDP of 1.4. Q2 GDP came out late last month in July, actually higher than expected. It was expected to be about low 2% range, and it ended up being 2.8, so on the higher end, and really driven from consumer spending. Consumers are out there just still spending money. And so it's hard to say that we're going to go into a hard recession when 70% of GDP is consumer spending, right? But what you do see here, though, is the economy growing at a slower rate than over the last few years. Doesn't mean it's a bad thing. Due to the US being the largest economy, we historically have been growing from between 2 to 3% a year, and we're right around that range. So on a GDP side, it's looking healthy. And like I was saying, since consumer spending makes up about 70% of GDP, looking at consumer spending, this is looking back from back at the beginning of 2019 to now, you can see the trend line of consumer spending. It fell off during COVID, but came back strongly due to all the stimulus in the economy, getting back to the initial trend line, maybe a little bit higher, but you see that continuing to grow and stay strong. Versus if this would cause more of an alarm if the consumer spending line were to look like this. This is looking at the beginning of 2007, going out to the end of 2010, the 08 recession that happened here. You see this trend line moving up, starting to weaken and fall off slowly, and slow recovery back up. This is a harsher recession that we saw and we all went through in 08. Looking at the trend line right now, that has not started to form yet. So consumers are still out.
Javi, can you back up to the last slide for a second?
Yeah.
A lot of times we get into the thing of, oh, here's bad economic news or here's good economic news. But like we talk about the stock market, over time, the economy grows. And, when we look at pre-pandemic, it was the consumer spending there, the PCE stuff was a little bit less than 15 trillion. You look at it now, it's 19.5 trillion. I mean, our country is still growing, from that standpoint. I think a lot of times we get too negative when we're looking at the data every day of this data, that data, and don't recognize, the growth that, and it goes back after 2008. Everybody said it's a disaster, the Great Recession, and it was, but we recovered from that. And, I remember back in, 21% interest rates in 1980, 81, how do we recover from that? We did. So.
Yeah, no, great point. And also when it comes to consumer spending, going on to what you're saying, David, is if consumers expect the future to be not as bright, they tend to pull back in spending, and you just don't see that right now.
Yep.
So then, shift gears to the labor market, you see us still growing. July's numbers came in lower than expected at 114,000 jobs created. The market was expecting about 180,000 jobs created. So lower than expected, but still positive. And you look back over the last few years, it's still growing. Yes, the long-term trend is a slowdown, but that's what the Federal Reserve wants and why they're raising rates. And so from now, they were raising rates to combat inflation. That's starting to taper down, which I'll show you here shortly. But now they're going to be focused on the unemployment rate. But the interesting part about the job creation is when you look a little bit deeper, is the type of jobs that are being created. And so this is looking at the last year of the jobs created, and you can see it's been mainly part-time jobs. that have been created versus full-time jobs. Full-time jobs are actually slightly negative. They have been coming back over the last few months, but it just shows you that while the economy is strong and still being spent, it's just not as strong as you may assume it would be, right? Not saying that the economy is bad, but it's just showing you some cracks right there, right? But going on to the conversation on inflation, what you see here is inflation really getting closer to the Fed's target of 2%. There's two lines right here, a blue line and a tan line. The blue line is Consumer Price Index, CPI. That's what you saw in the news a couple of years ago of it hitting 9%. And you see it going down a good chunk with the Federal Reserve raising rates. But over the last year, remaining a little sticky and somewhat flat. Well, you're starting to see it to be less stubborn and going back down and closer to the 2% target rate. Inflation came out today, this morning actually, and it actually was lower than expected at 2.9%. So it's still making moves slowly, but it's getting there. What you see here, though, is this tan line. This is actually the Fed's preferred measure of inflation, which is Personal Consumption Expenditures Index, PCE. And the reason why they like looking at this line a little bit more is because it excludes some volatile items that's in CPI. But you see this actually being closer to the 2% target. And the next one will get released later this month. And if the trend continues, we could definitely see a rate cut here in September. The interesting part that the Fed is looking at is this chart right here, which looks at consumers, and they ask consumers where they expect inflation to be 3 years from now. And so this is not showing you inflation real time, but more of where they expect it to be 3 years from now on the consumer end. And what you can see is consumers expect inflation to get back to the normal range in about 3 years. They're more optimistic. The Federal Reserve likes this a lot. The reason being is if the consumers expect inflation to normalize in the next few years, they're not going to go out to jobs and asking for a 10 the 15% pay raise. Their pay raises will be more in line to the inflation rate, which would help slow down the spiral of inflation. So that's a good sign there. An interesting part that you see here back in 2022, when inflation was reaching 9%, the consumer, they believed inflation would be 4% 3 years from now. Now, fast forward, we know that's not the case, but very interesting to see. So good news for the Fed. So when you look at our GDP, consumer spending, labor market, and inflation, all positive signs. There is some cracks, right? More part-time jobs and full-time jobs, but still humming along and still growing. So making it the possibility of a soft landing very feasible. That leads me to the next thing is how healthy is the stock market? And I'll go ahead and let Eric take this over.
Yeah, so this is a question that we get a lot, and I think we oscillate back and forth between roller coaster ride or sailing. And so we've got two slides. Is this clear sailing moving forward, or are we choppy waters ahead? And the answer is yes. It's a little bit of both, right? It is that roller coaster ride. One of the slides that we didn't put in here, and David, you and I were talking about it. And kind of going back to Javi's data is. When is good news good news? When is good news bad news? When is bad news good news? Right. So the market right now is walking this tightrope, and everything all the data that's coming out, everybody's keyed on, and you have these announcements that occur. And if the expectation was 1.8 and it comes out at 1.7, market tanks. Expectations are 1.8 and it comes out at 1.9, market rally, right? So it's not that the expectations 1.8 and it comes out at 0, or the expectations 1.8 and it comes out at negative 1.8. You just have these very small changes that are occurring that are causing the volatility that we're seeing, not unlike what happened in Japan. But really, when you start to look at, okay, is the stock market expensive? And the next slide here really is a table of no matter what metric you look at. So starting at the top on the left-hand side, S&P 500 forward price to earnings ratio, or the S&P 500 trailing price to earnings ratio, right? The dozen or so metrics, all historically or relative to history are expensive or very expensive. Now, this chart takes into account data only through the end of June. So you think about the volatility that we've seen in July and recently here in the month of August. Some of this might change in color a little bit, but really this is the maybe not necessarily price to perfection, but as the market has rallied, we had a very good 2023, a great first half of 2024, and it is expensive. And what we do know, and we've talked about this before, is that the market can remain expensive or very expensive way longer than you want it to, or that you think it should last. And that's the pain that it kind of puts. You have a lot of pundits, depending on what you read, what you watch, what you listen to, that pound the table on bear market's coming, market's going to roll over. And at some point they will be right. It just never comes as quickly as they want it to. And so, yes, the market's expensive, a little overbought. You see that volatility spike when you get information and activity that's out of the norm. Very unexpected, but it continues, and for the most part is recovered from that Japanese trade that has occurred. You know, the other slide that we like when we think about is the market healthy, is we are seeing broader market participation. If you go back and rewatch the webinars that we've had in the past over the last year, some of the meetings that we've had with you, we talk about the Magnificent Seven, right? The NASDAQ, the S&P, the Dow Jones. This chart goes back to middle of July to the middle of August. You have Apple, Nvidia. If they go down, that index goes down and just drags everything with it. The top line is the S&P 500 equal weighting. If you looked at all 500 companies, if they were all the same size, they were all priced the same, you don't see that volatility. That index equal weighted did not get dragged down over the last month, even though some very specific, very focused indexes did. And so we like to see that more companies are participating in the growth of the market. And so that is reassuring when you start to peel that onion and look at everything under the hood. You know, the other part that we continue to come back and remind is that dips, pullbacks, corrections are very normal. This is data going back to 1928. So we're looking at almost 100 years worth of data. You start at the bottom, the dip defined as a downturn greater than 3% on average happens more than 7 times a year that you should have that type of volatility. A pullback, which is greater than a 5% downturn, should happen between 3 to 4 times per year on average. Correction, which is a greater than a 10% pullback, happens once every year on average. And so while nobody likes to see the account go down and you see those exaggerated dips, pullbacks, corrections, they are very normal. They will happen. A unhealthy stock market is one that only goes up. Again, we like to see the value, your net worth continue up, but we need some correction. We need to provide some healthy growth, which is up and down. So really the last slide, the next slide here is a bigger understanding. You go back to early 60s. This is a graph of the blue up is bull market when the market's going up. The brown bars on the bottom are bear markets when the market's going down. And that solid line that's going from left to right is the S&P 500 over time. And while you have a choppy sailing ride or roller coaster along the way, right, it's not a straight line, but for the most part, you're going up more than you're going down. And while the choppy waters are not fun, you don't know when the bear market, the recession is going to happen. You go back to 2020, that was a 1 month 34% downturn. You have no idea if it's going to only be a 1 month bear market or if it's going to be a 31-month bear market like in the late or in the early 2000s. And so that's where it's a move everything to the side, let it happen, get back in. We are not a big fan of that. We have models that we're running, and we'll talk about that in a little bit as well. That we will take risk off because it is very difficult and not beneficial to try to time the market. And so over time, you're going up more than you're going down. But on the roller coaster, on the down, on a Wednesday, it is tough. But the emotion that comes along with it, we're trying to help manage through that. So with that, just kind of going from a healthy stock market to more of a economy in US, a lot of the questions that we get, and David, you can probably talk about this a little bit more, is does the US have a spending and or debt problem?
And the answer is a resounding yes on both accounts. And this chart tells that exactly what you need to do, or exactly the way it has been and where we are right now. This goes back to 1790. Now this is historical debt to GDP. So how much debt outstanding divided by the annual GDP. Now, what you see is the dotted line down there, the red dotted line, basically shows that it's about 30-35% is what the average has been. We're way above that. We're up at the 120% level. But usually what you see is it goes up dramatically, and you can go back to the Civil War, where it went up dramatically. You're fighting a war. You go to World War I, you're fighting a war, not quite as intense. And then you're at World War II, which was huge, a whole world war. And yes, we borrowed a lot of money as we fought that war. But it's supposed to go down when you're in good times, when you're in full employment, when the economy is chugging along and doing fine. You should be paying down debt, or at least not increasing debt. And if you're not increasing debt, GDP goes up and debt doesn't, then this percentage goes down. And yet we're not seeing that hardly at all. And this shows the amount of debt that we've accumulated. And the next slide is how much we're accumulating as a percentage of GDP each year. So the zero line means we've got a balanced budget. Anything above that, we got a surplus. Anything below, a deficit. Well, you can see it's been a long time since we had a balanced budget. And if I went back another 30 years before that, you wouldn't have seen it either. Now, in the Great Recession, you see a big drop down to where we were nearly 10% GDP deficit that year in 2008-9, because we were bailing out the banks. We were bailing out more homeowners. We were doing everything to get out of the recession. That's what you do. And then as we got out of the recession, the deficit as a percentage of GDP went down, and you would say, hey, we're doing pretty well. And then it started increasing. And then we got to the pandemic and it blew out again. And we absolutely needed to do that. When you shut down the economy and schools and small businesses, you had to do that. But then it should go back, and it's stubbornly above 5% as far as GDP, the deficit. The gray bars are the projections by the Congressional Budget Office of where we're going to look at deficits going forward. You're not seeing any improvement. And in fact, these numbers are based on current law, which current law says in 2026, everybody's tax rate goes up. If that is not current law, if those are extended, these numbers are even worse. And unfortunately, in Washington, nobody cares. Everybody talks, like I say, it's like the weather. Everybody complains about it. Nobody does anything about it. And, it's on both sides of the aisle. Nobody has any real, they talk about, we're going to be more efficient. So that's not the issue. You've got hard decisions to make and nobody wants to make them. So that is ultimately, if we continue like that, there will come a time when it will be a problem. But right now, the unbelievable statistic is that this year we're going to spend more on interest on our national debt than we are on national defense. Sad commentary of where we are, where the average consumer is in decent shape, our federal government is not. Now, average consumer doesn't have a printing press, so that does change things, but it's still not a great thing for us to have 34 trillion of debt. And I don't see that changing anytime soon. So let's move to something that we are positive on and are optimistic about, and that's what we're doing in the portfolios. And if we go and look at the total return income portfolio on the bond side, the middle two bars are where we're at. We've got junk bonds, we've got bank loans, and the yields are so much higher than they were 3 years ago. It's nice to see. Our average yield, I think, in that portfolio is 7.6, 7.7. And we're happy where that is. It's fully invested. We've been that way for a while. We sold out of some of the junk bonds for less than a month back in the spring when we had a little glitch. But we're perfectly comfortable with that right now.
And I think, David, we kind of talked, our expectation is when you think about the Fed going to cut rates, right? Not if, it's they're going to cut. And so when you think about the money funds that some clients are in that are
Yep.
earning 5%, which is a very refreshing difference from the 0% that everyone was earning in the middle 2010s. That as the Fed cuts rates, that not only the money funds and T-bills will correspondingly drop that, but we do expect some reduction in the yields within the funds.
Yeah, no, absolutely. And if, I actually suspect it's probably 50 basis points, 0.5% this year, that we'll see on Fed funds dropping. That means, money markets are going to be at 4.5, T-bills are going to be in the same area. Maybe it's 100 and money markets down at 5. In this scenario, I think you're still in the mid 6s to low 7s if that occurs in our portfolio. So I'm perfectly fine. I mean, if you look long term, a 5 or 6% yield on a bond portfolio is a really good, yield, and we're above that. And I think we'll stay above that for several years. So we're happy knowing that the higher longer has actually helped us. Because if you remember, they were talking about 5 to 7 cuts at the first of the year. Well, here we are in August. We haven't had the first cut. So that's helped us because, people were talking about it being in the 3s as far as Fed funds by the end of the year, at the first of the year. And it's, it might be in the 4s, and that's it. On the equity side, we're still fully invested. What you're seeing is we still have a tilt to growth because it's over the last 2 years has done much better. It's still doing a little bit better, but we do have value. We've got a Vanguard large cap value in there, along with the Vanguard growth and mega cap growth and Russell growth. So there is a tilt to the growth. We're not betting the farm on it. What you're not seeing in our portfolios on the stock side is emerging markets or international developed. So international developed is Europe, Australia, Japan, Canada, that kind of stuff. And you don't see it because they have not performed well, and they haven't performed well for years and years. So we're not going to have them in there as a diversifier if they're not adding any value at any time. Back in the early 2000s, 2003 to 2007, we made a lot of money in international emerging markets. But until we see the dollar weakening, and that's what happened back in those years, we're not going to be in it because if it's strengthening, it's going to be a real headwind for international to do well. I'm sure it will at some point in time, and our malls will start moving us over into some of that. But right now, we're nearly all U.S. domestic with more on the large cap side with a little tilt to the growth side. So we're optimistic. I mean, when you look at the returns year to date, we've got a very healthy return for the full year, and we haven't even gone 8 months. So hopefully it continues, or at least doesn't deteriorate a lot between now and the end of the year. And now we'll turn it over to Eric to talk about something that's not as fun.
Yeah, this is more a PSA, public service announcement. So the amount of financial fraud that we see is definitely on the rise. And please stay with me. I know a lot of people start to glaze over. You see this in the news, and a lot of it is, well, it's not going to be me. I know it's out there, but I'm fine. I'm not responding to the Nigerian prince email that if I send him $10, he'll send me $10 million. That is not what we're talking about. The sophistication that has occurred from what we used to know as scams via email that everyone kind of understood. Nothing was spelled correctly. It was coming from obviously emails that you were not familiar with. The sophistication and the relentlessness that we see of people coming in as impersonating government officials, impersonating businesses, and the people that are falling prey. We talk with Schwab as our custodian, and the examples that they have. We talk to other advisors that have clients that are successful, and sadly enough, some of our clients that have gotten wrapped up to this. And again, we're not talking a 102-year-old individual who has Alzheimer's, who is in a position to not really comprehend what's going on. We have working professional doctor, lawyer, business owners that when the IRS is calling them and giving them all of their personal information, providing credentials that if you went to LinkedIn or you Googled them, they showed up as actual people. But it is a length that they're going to, telling you that they need you to help participate in catching the bad guys, and they want you to use your IRA to draw the bad guys out. And really, there's almost no recourse for that. We are seeing this time and time again. This is why we call you every time you want to move money. We need to be able to talk to you, and we haven't even got into the AI side of this yet. This is just relentless individuals. You look at the data on this chart here, 1 in 5 individuals. So if we have 100 people on the call, 20 people at some point are going to fall victim to some sort of a fraud or abuse. And the just crazy part of it is that they are giving their victims questions and answers, so that if your children question you, what should you be responding? If your financial advisor, if your bank is asking, questioning what's going on, they are feeding their victims information, because you assume that you're helping the Social Security Administration. You're trying to help Medicare in capturing, and it is it's relentless. So we will continue to talk about this. We will continue to give more examples, both on the webinars, when we meet with you in person, when we do Zoom meetings, because this is something I think that gets a little lost. We all become tone deaf because of the amount of information that's out there, but we are seeing this, and it just continues to grow, which is sad. So more of a PSA, and more to come on this. So
And one thing,
we probably could have done a full hour on this as well.
one thing, Eric, is I think the biggest thing is, keep us in the loop. Let us know if someone reaches out to you. What they're going to tell you is, hey, you can't share this with anyone. That's a big red flag. But keep us in the loop. That's what we're here for. We can also do investigating and help you make those decisions, right? And so, feel free to utilize us in that way as well.
Absolutely. Great point. So before we wrap up, I think, one of the other questions we get this time of year, and Javi, I think you can talk about this a little bit as well.
Yeah. And so being an election year, what we're getting a lot of, right, is what changes to make to the portfolio due to it being an election year. And really that comes out to none. Changes to a presidency doesn't mean to change your portfolio around. There is instances to change your portfolio. There are situations. One is what changes to your plan is coming up, right? Are you going to retire earlier, retire later, different life goals? That's when we want to make changes. Or not to say, if there is a change in the stock market, there is an area or sector doing better, we will make those changes. Our models will pick that up and go ahead and make those changes on its own. But we should not be making changes due to a Republican or Democrat being in office, because that's always going to be there. Every 4 years, this talk's going to come. And so we need to look at the numbers, look at the economy, look at the stock market, the health of them. And then from there, let the numbers tell us and the algorithm tell us where to be in. So that's just one thing we had here. And we're towards the end of the presentation. And the last part would be our question and answers Q&A portion. Eric, I'm not sure if you have that pulled up, if you want to go through that list or.
Yeah, we've got one question I know that actually came up a week or so ago, and David, I think you were talking to somebody about this, kind of going back to the Fed
Yeah.
They're meeting at Jackson Hole. We don't anticipate them making any changes. They have an FOMC meeting in September. What's the likelihood that they have some sort of emergency Fed meeting? Like, how does that work where they come in and they didn't want to wait till September? Like,
Yeah.
how likely is that? How does that work?
Yeah, so the FOMC is set every 6 weeks throughout the year. They have a meeting. And that's when they announce any changes, what they talked about, changes in policy, that kind of stuff. But they can have an emergency meeting, as you referred to, where they get together and say, hey, something's happened. We need, and usually the emergency is to lower the Fed funds rate because something bad has happened. But like you showed, every year there's a 10% drop in the market at some point. Is that an emergency meeting? Typically, no, not at all. You see emergency meetings like 1987. There was one long-term capital in 1998. During the 9/11, there was emergency meeting. There was emergency meeting in 2008, the pandemic. Those are times when you see huge drops, huge uncertainty, but jobs numbers missed, or so-and-so missed earnings. That's not going to happen. Because it should come, an emergency meeting means there's an economic emergency here. The last thing the Fed wants to do is panic everybody when, as we've shown, you've got consumer spending. Most people that want a job have a job. Inflation's sort of, slowly getting down and getting under control. GDP, I think Javi showed the, last quarter is 2.8. It's expected to be between 2 and 3% this quarter. There is no emergency here. Now, if Iran and Israel broke out in a full-scale war and that type of stuff, that disrupted everything in the Middle East, and so oil spiked to $120 a barrel, yes, that would be an emergency potentially. But what we're seeing here of, the market sold off, and that's not an emergency. I would be shocked if they called an emergency meeting for anything other than war breaking out or something, some huge move. So I think that's a non-event. We will get some more information, though, at Jackson Hole, in that, one of the things that you've seen is Powell typically uses one of his speeches, and sometimes it's a press conference, where he will basically outline and reinforce what he wants the market to be thinking about. And I suspect this will be, we are on track to be able to reduce rates. And he won't say, in September, we're going to reduce them by quarter, because it's only going to be another week or two before he's going to do it. He's probably just going to say, we're on track to reduce rates in the near future.
I think that kind of an extension of that, and I know we've talked about that earlier this year, when you think about going back to the slide where I was talking about what is the Fed telegraphing that they want to do versus the market expectation. And I think it's the market for the last, remind me, David, the last 2 years has been wrong, right? The market expected, like you said, January of this year, the market expected 6 rate cuts this year.
7.
And we're in the middle of August and nothing's happened yet. And so just because the market wants some things and is betting, and you see those odds, doesn't mean that that's what the Fed for the last, I don't know, since probably Greenspan, right, has tried to telegraph to not surprise. Yep. A lot of talking, but yeah, unless you get a 9/11 or a 2008, that they want to be measured and no surprises.
And I think when we look at it and the data we're seeing right now, our best estimate is there is a 0.25% probably in September, and probably another 1/4 to 1/2 between then and the end of the year, because you'll have 2 more meetings before the end of the year after the September one. And I think that's what you're going to be looking at. Maybe it's 50 basis points total, maybe it's 75, but it's probably, my best guess, if you put a gun to my head, probably 50 basis points this year.
I got one for you. Somebody, and I know you were talking about this in a meeting last week. The question is really, inflation's going down, right? We see the chart, everybody's talking about that, but when are we going to see prices come back down to normal?
Yeah.
So I think there's a little bit of a disconnect. So maybe you can talk about that.
Yeah, so and it does come up quite a bit, right? When I show the chart of inflation starting to stabilize, resume back to normal, people say, "Hey, I don't feel that." And so really what inflation is the rate of change of prices going up, right? It's not prices going down. And what I mean by that, if a gallon of milk 1 year cost you $5, the next year it costs you $10, that is 100% inflation. If the following year milk stays at $10, that's zero inflation. It's the rate of change of prices going up. So to say that prices are going back to normal, this is the new normal per se. There could be some changes and fluctuations based off some commodities, right? But inflation is the rate of change of things going up, not low prices. We want stable prices. We want prices to go up about right around the 2% range year over year.
And I think we got a little complacent right over the last decade or more where we didn't see a lot of inflation. And David, early on when I joined Copperwynd, we were talking about how are we going to make our way out of this 0% Fed funds rate? We've held rates so low for so long, and we weren't ever seeing any inflation. And so I think most people got used to less than 2% inflation. Then all of a sudden, inflation reared its ugly head. Everybody definitely felt it in the pocketbook as prices rose. But there is a tendency on when are they going to go back down again? That's different. That's called deflation, and that's a careful what you wish for.
Yeah. And deflation is actually a very bad thing for the economy because in a capitalistic society, it doesn't work because if prices are going down, you look and say, oh, I like prices going down. But if prices are going down, then where you work and price goes to go down, well, then they've got to cut expenses, because they're not selling stuff for as much. You don't like prices going down when your home price is going down or your 401k is going down. So we get in the thing of, well, when is the price going to get back to where it was? It's not. On the commodity side, it can, because commodities, we produce more and they go up and down, but you're not going to have a $25,000 average price of a new car. It's just not going to happen. If it did, it would probably be a disaster economically.
Eric, I see a question that just came in here, and I think since you spoke about rates, since rates are expected to go down, should you wait to buy a home, or should you go ahead and buy the home now?
Yeah, we've been getting a different flavor of that question over the last couple of years as mortgage rates. For everyone that enjoyed a 3% mortgage, as they kind of spiked up to 6, 7, 8%, that we did see some hesitancy on buying houses. You don't want to take a big mortgage. Interest rates are coming back down, into the mid to low sixes, and do we want to continue to wait? I think there's two different things. Obviously, the cost of buying a home is one thing, but at some level, everybody needs a place to live. Kind of like time in the stock market. I want to wait until prices are low, then I'm going to buy. The stock market will go back up. I think you run into some issues if you're just waiting for a much lower mortgage rate. If you need a place to live, you find the house in the city that meets your needs. The reality is that if rates go back down, you could refinance down to a lower rate. Just waiting because we just have no idea how long that's going to take and if that house is going to be there for you. And so you have the ability to refinance. I wouldn't necessarily wait if it's something that, and the reality is we're not going back down, at least anytime soon, I would imagine, to a 3% mortgage. So, a 4, 5, 6% mortgage is still historically, looking far enough back, a good mortgage. But I know if the only thing you were keyed off of was the 2.5%, 3% mortgages, it seems expensive.
Yeah.
So kind of on that same line, David, a question coming in on the commercial real estate side. So
yeah,
coming out of the pandemic, are we seeing the foreclosures? Is that a crack in the bigger economy that potentially is going to occur?
It is potentially an issue. and where we're seeing it is mainly on the office side of commercial real estate. If you look at the delinquency rates, they spiked up dramatically in that space. You're not seeing it on industrial, so like warehouses, they're very low vacancy rate, very low delinquency rate. On apartments right now, very low delinquency rate, very low very low vacancy rate there. I do think that probably apartments are getting overbuilt, but it'll be probably a couple of years before you'll see that. But I do worry on the commercial real estate. Now, a lot of that is being held in pension plans and other things, the mortgages on those, and with insurance companies. And we'll have to see. I think some of those are ultimately going to be repurposed as residential stuff. You saw that in downtown Manhattan 20 years ago when they repurposed a lot of office buildings and made them into condos and condominiums and in co-ops. But that is a fairly small percentage of the bond market. But I do remember, the Fed chair in 2007 when somebody brought up subprime mortgage, and his comment was, oh, it's not going to be a material impact because it's a small portion of the total mortgage market. Well, that didn't turn out too well. I don't think it's that. And it's not like there are plenty when you look around here, like in Phoenix and Scottsdale and all over the valley. There are lots of office buildings that are completely rented out and fine. I think where you're seeing some of the big issues are the work from home stuff, where somebody in the big city has huge space that's in a downtown facility, and they say we got 8 floors, we're only working 3 days a week here, so we only want 6 when the lease comes up. And all of a sudden you're going to have a lot of space. So
we got we've got a question coming in, and David, you may speak to this a little bit. We don't have a chart in our current presentation talking about kind of just our historical wage growth. What have we seen? I think there's a number of ways to break that down. If you think about wage growth of high school graduates, wage growth of college graduates, right? And so, depending on.
So typically, if you look at the historical numbers, they're going to be about what the nominal GDP growth is. Nominal being the GDP plus real GDP plus inflation. Because the reality is, what I can pay people is what growth in the economy is plus productivity growth. And that's where you'll see it. The wage growth the last few years. I mean, I saw a thing, and I think it was from 2019 or maybe early 2020, that you had 23% wage growth across the board. Most of that was in 21, 22, and 23. Now you're seeing wages sort of going back to more normal time. That's the one problem, and Javi talked about it. If I think inflation is going to run 5%, well then, if I'm a union, if I'm a worker, I don't want a 2 or 3% increase, because if inflation's 5, I'm losing 2. So I think the wage growth going forward is going to be similar. Now there is some scenarios, and this is where AI is quite exciting. Can it make me a lot more productive? If I can be more productive, I produce more, and they can pay me more. Now it still remains to be seen, but that is clearly what helped in the 90s with the internet and personal computers to have just a really good increase in GDP and productivity, and therefore wages. So, but historically, you've seen it somewhere in the 3 to 5%, annualized. It's been higher than that, more recently, but from 2010 to probably 2020, it was below that. I mean, people went, some of them for years and years without hardly any kind of increase.
And one thing about that is I recently saw this chart on, the wage growth, of real wage growth, right? When you accounted for inflation over the last few years. And so what I saw was when inflation was going up, the wage growth was not keeping up with inflation, right? So you're negative. So, a few months later, it flip-flopped. More wage growth was outpacing it because inflation was going down. People were asking for larger wages increases. They were receiving them. So inflation was going down to, let's just say, 4 or 5%, but they were getting wage increases of 5 to 10%. So they had an extra 5% in the bank to go out spending, right? Now, fast forward to where we're at now, that has gone down more closer to the inflation rate, but there's still some excess funds that people are able to get due to the people still looking for jobs. There's a lot of jobs out there. So.
And that's why the Fed is so, so focused on inflation expectations Javi, you were talking about. If I expect it to be a lot higher, I require more, and that, gets worse.
Exactly it.
I think that's a kind of a common theme, stepping back when you think about the data that's coming out saying, oh, unemployment used to be 3%. Now it's at 4%. That's maybe heading to 5%. Again, historically, 4% unemployment, 5% unemployment is in line and is not excessive. But the change from 3% to 5% from a percentage standpoint is a large change. And I think that's some of the shock of the numbers, and being able to understand, are we zooming in or pulling back out again to understand relative. We have the conversations on, I'm employed, I'm getting paid, I'm fine, but it appears that everybody else is not doing well. That's another kind of a bigger thing that we see. It was like, well, if we all personally feel like things are okay, but we project and we think here that everyone else isn't doing well, it is that you have a little bit of a negative view on what's going on in the economy, but there are some cracks in the armor there a bit.
Yeah, so I see another question about slowing construction in Utah. Are we seeing that in other areas also? You're seeing a little bit more of slowing in some areas. I think you're seeing, when you look at new apartments started, or building permits issued for those, you're seeing a significant slowdown there. We'll see if that's just a blip or not. It's really been the last 3 or 4 months that you've seen that. But yeah, I've got to bet that when I'm at nearly any other, all the way from, we were in New Mexico a few weeks ago. I'm up in Utah, Idaho, Colorado, Texas. You just see lots of apartments being built, and I just got to bet. And I think you're seeing that here in the Phoenix metro area, in that the last year rents have not hardly gone up at all. And I think that's where you're getting the saturation. So, and I think one of the things that where that also goes to ultimately is people, they say, yeah, but house prices are still high. They are. But if rents start to come down, there will be more houses come on the market, because if I've got a rental property and it's fully, leased, that rental house, and it's fully leased, that's great. But if I've got a mortgage on it and all of a sudden it becomes vacant, and it takes 2 or 3 months before I can rent it, all of a sudden I say, I'm up, $150,000 on it. Let's just sell it. I don't like having to, fork over money for that. And all of a sudden you've got another house that's on the market. And I think same thing. It'll remain to be seen whether the Airbnb homes continue to be as profitable as they have been. I play tennis with a guy that has a couple of them, and he told me, he said, it was great in 2021 and 2022. He said, but I've had some vacancies and I'm having to make some payments now on the mortgage where I wasn't before. He said, I'm just going to sell them because I got a big gain in it. And, if that continues, you would see more houses on the market. We'll see.
Yep. So I think we're right at the top of the hour. We got into most of the questions. If we haven't gotten to yours, we'll connect, reach out, and make sure we answer them. So I want to thank everybody for